Hey guys, I'm just gonna film this short video on one of the midterm review questions. It did confuse me a tiny bit, so I just kind of wanted to go over how it's done to help me study and hopefully to help you study. So this question comes from the midterm review, and you can see that I've sort of transferred it into Canvas, and I've set up some cells here so we can pull information out of the question. In this question, we're told that a company has this following bond on its statement of financial position. So they have a $6 million bond with a 7% coupon rate. And then we're told that on the 20th of February 2008, they're going to retire 20% of the bond. And in exchange, they're going to receive $1,320,000 of cash. They pay out interest on that date only for the portion of the bonds that were retired. So the people whose bonds they're retiring do get the interest they've accumulated up till that point. And finally, we are told that premium amortization was recorded on this date, and they recorded $480 of premium amortization. So the best thing we can do here is we can start pulling information out of this question in order to make our journal entries. And I have some cells set up here for that. So the first thing to do is let's just start filling these out. The face value of our bond is $6 million. The coupon rate is 7%. The premium is $50,400. The cash we're getting on retirement, we're told in the question, $1,320,000. The premium amortization, this is the amount of premium amortization we recorded on February 28th, is $480, and the percentage of the bond we're retiring is 20%. Now, we need to figure out what is the payment, because this is going to be relevant to our journal entries. Each time we reach a payment date, in this specific case, the 31st of December or the 30th of June, how much money do we pay out to our bondholders? And we're just going to do a tiny bit of math that should be very familiar. The interest we pay is equal to the face value of the bond times the coupon rate, and in this case divided by 2 because we pay out twice per year. So each time we reach an interest payment date, we pay out $210,000. And these will just sort of help us determine certain values. Remember, we're not retiring this bond on an interest payment date on a nice even date. Our last interest payment date would have been the 31st of December 2007, but now it's February 2008, and this is the date we're retiring the bonds. And what this means is that 2 months have passed. You can either look at it as 2 months between payment dates have passed. So since there are 6 months of payment dates, 1/3 of the accrual period has passed, or you could look at it in the scope of the whole year. In the whole year, 2 months have passed. So when we consider payment dates, we can press equals 2 out of 6 months have passed, or exactly a third of the payment accrual. Or in terms of the whole year, 2 of the 12 months have passed, or 2 divided by 12. And about 16% of the year has passed. So now that we have these numbers, we can just fill in our journal entries. And some of these entries will be very simple. In fact, some of them are just given in the question. We're told we amortized $480 of the premium, so that's already done. We're also told we received $1,320,000 in cash, so that's already done. We're told we retired 20% of the bond, or 20% of $6 million. So we can press 6 million times 20%, and we'll just make this visible, is $1.2 million. So we have that entry. So the rest of these are going to either be plugs or require a little bit of math, and we'll go through them now. So the first thing is we need to know how much cash we paid out for the interest that was accrued. And this is equal to the amount of the payment times 20%, which was retired. So we're only paying out on 20% of the bonds, times the number of months we held it, in this case 33% of the period, or 2 months. And we're going to see it's $14,000. Now Connect here does take this into account differently. Connect looks at this through the whole year, but you can also arrive at that $14,000 in a different way, and I'll show you here in this cell. If you want to consider the whole year, the amount is going to be equal to $6 million times the coupon rate times 20% of the bonds we're retiring times 2 months of the year, or 2 divided by 12, or it's a little over 16%. And you're going to see that we also get $14,000. These are just two separate ways of looking at it. One with the payment, which is sort of how I assumed the question wanted it done, and one where you consider the whole year, which is sort of how Connect did it. Now, in this case, our interest expense is a plug. We don't have the full amortization table, and we can't make it with the information we're given, so we've just kind of got to trust in the question. And in this case, it's going to be our credits minus our debits to balance. We're going to get $13,520. Next, we need to know how much of the premium we're retiring, because the loss or gain will be a plug after that. And just from eyeballing this, since the entire amount of the premium is $50,400, no matter how much of that premium we retire, it's not going to get us up higher than 1.3 million. So we kind of already know that our loss or gain on retirement is going to be a loss, just as we set this up and start eyeballing things. But to figure out exactly how much, we need to know how much of the premium we're retiring. And in this case, we're retiring 20% of the premium. So we take the value of our premium times 20%, but we have to remember we already retired some of the premium up here in this question. So since this amount has already been taken into account, we're going to subtract it from the amount of the premium we're retiring. And we get $9,600. So if we total these up and we can look down here, we see this number is not 1.3 million. So we need to balance on our left side, on our debits. We're light here. So what we're going to do is we're going to press equals, and we're going to subtract our debits from our credits to get the entry we need to balance. In this case, 110,400. And that's everything. That's how you do this question.